Food prices, a visceral reminder of inflation for many Americans, are up a stunning 21%. So they are still expecting rates to go down by the end of this year, which might be helpful for borrowers. So, anybody that's breathing and going to the grocery store knows this stuff. Homeowners insurance, auto insurance, it's all going through the roof. Hey guys, Capper here. Welcome back. Well, the big topic of today and real estate recently is the Federal Reserve and interest rates. Today's a big day, and I'll tell you why. I'll go over an article with you. And if you don't realize it, they have called the Federal Reserve Chairman, which is, his name is Jerome Powell, the strongest or the most powerful person in the world. Yes, even above the U.S. president. If you don't follow interest rates, I'll try to explain to you how this all ties in together. But today, a decision's expected. Usually, I think it comes out at 1 p.m. I don't remember if that's Eastern or Central time. I used to watch it live time. For interest rates in the U.S., the Federal Reserve controls interest rates. So it's not necessarily free market. When you get a car loan or when you get a home loan or a mortgage or any kind of loan for that matter, it's the Federal Reserve that actually borrows money to banks, and then they add interest on top of that, and then they borrow it to you or they loan it to you. So that's how they make money. So currently the Federal Reserve's lending rate is 5.25-ish. They call it a range, is 5.25 to 5.5. So let's go over this article. Today we're going to go over it from Fox Business. The Fed's expected to keep interest rates higher for longer amid stubborn inflation. Now, if you're breathing and you go to the grocery store, you're pretty well aware of stubborn inflation. I don't need to go into details about that. And part of the reasoning, at least in my opinion, and I'm not giving any financial advice or anything, it's just simple. Government spending. These trillions of dollars are getting pumped into the economy. It's just common sense. Anyways, a few months ago, Wall Street was confident that May would mark the beginning of interest rate cuts by the Fed, which would mean, so the current rate's at 5.25 right now. So he actually said, which when the Fed speaks, they call it Fed speak. He actually moves the stock market just by what he says, not even by what he does. So what he said a few weeks ago is he said that the Fed is likely to start lowering interest rates. He's been hiking rates for the last couple of years now to try to tame inflation. And that sent the stock market up because lower rates mean better borrowing for everyone and means the economy's going to go. But the problem is inflation ain't coming down like they thought it was going to. So let's continue. But a string of hotter than expected inflation reports at the beginning of the year has poured cold water on the expectations, and the debate has gradually shifted from how many times the Fed will cut rates this year to whether it will trim them at all. We're probably not getting any rate cuts this year. And then you got politics. It's not supposed to be a political arm. The Federal Reserve was set up to be the super uber neutral position. And it's a board of positions, but there's one chairman, and then there's all these regional Federal Reserve, chair people. Fed officials are widely expected to hold rates steady at 5.25 to 5.5, the highest in the last 22 years, and make only minor changes to their policy statement. So their policy statement, like I said, what they say can drive markets. So the market watchers listen to what the Fed says, and then they try to look forward. Like the stock market is kind of a forward-looking instrument, as so are bonds and banks and that. So when they lend you money, they kind of want to know at least what's going to happen in the next year or two. Speaking of that, so we got a lot of guff on our Missouri farm on why we're buying now. So there's a couple things, and I get the concern people have. Rates are high right now, but it's also reducing buying competition. If you could afford to buy now and sit tight for a couple years and then refinance, because rates are likely to come back down. The arm we're getting is a 5-year note, so we've got roughly 5 years to refinance that into a fixed mortgage. So if rates even come down half, 0.75% or 1%, that will greatly reduce our new mortgage. So there is kind of an advantage to shopping now because the buying pool is smaller than even if they drop rates 0.5%, that's going to bring out more buyers in the market. And I mean, the other thing is, if we're buying at the top of a bubble, that could hurt us. A bubble, obviously you got everything going up, and you're buying up here, and then we have a market crash, and now your land is worth less, or your home. That's possible. That is possible. But land holds up better than homes, and different regions are worse. The areas with higher populations have different metrics, and they're selling much higher than other areas like where we're buying in rural areas. So hopefully we're not buying at the top of the bubble, but we're planning on staying there, well, as long as we can, till the end run, I guess. Despite evidence that economic growth is beginning to slow, the Fed isn't as close to cutting rates as they thought they might be at the last meeting in March. Inflation has continued to run hot, and there is no compelling need for the Fed to cut interest rates until they're comfortable with where inflation is headed. And their goal, the Federal Reserve's goal, is to keep inflation at about 2% every year. A lot of economists kind of agree that 2% is like a natural thing for a growing economy. So they feel that it's healthy. A lot of people would say, well, I don't want any inflation. I want prices to stay the same and that. But it's really tricky when you think of a growing economy. That's just how it is. I'm not a total expert on that, but they agree that they want to see 2% annual inflation, generally speaking. Updated projections laid out after the Fed's March meeting show that a majority of committee officials expect rates to fall to 4.6 by the end of 2024. That's only a few months from now, suggesting that means there's at least a 3/4 point rate cuts this year. They usually cut 1/4 point at a time, although they could cut 1/2, or 3/4 all at one time. So right now rates are at 5 1/4. Some people are still expecting just by the end of this year to be down to 4.6. Now for us, if we get moved and then we get this house sold, that would be great for us because we could refinance early next year, bring our mortgage down. We'd be in pretty good shape. But I'll believe it when I see it because, like I said, if you go to the gas station and grocery store, you know about the inflation. All right, so let's skip over. So today he's going to make the announcement, which is probably just going to be neutral. He's not going to raise rates, but he's definitely not going to lower them. But here's a new article here. Inflation accelerates more than expected in March. Why are we talking about March? Because everything is kind of lagging, so all the data has to come in for the CPI and the PPI, the producer price index, so everything is lagging. But as you guys know, just from living, like I said, inflation is not coming down. All that's happening is the rate of inflation is kind of coming down, but it's still at 3.5% year over year. And inflation accelerated in March for the third straight month. So that means January, February, March, inflation went up when they thought it was going to either stay neutral or go down. So like I said, it's still at 3.5% year over year on the last reading. And that's why the Fed really shouldn't be cutting rates right now. Because if he cuts rates, it'll stimulate the economy, which will push more buyers out there, and then that will make inflation even worse. Let's see what's really the important part to know. Altogether, the report indicated that while inflation has fallen considerably from a peak of 9.1%, it remains well above the Federal Reserve's 2% target. This marks the third consecutive strong reading and means that the stalled disinflationary narrative can no longer be called a blip, said Seema Shah, chief global strategist at Principal Asset Management. High inflation has created severe financial pressure for most U.S. households, which are forced to pay more for everyday necessities like food and rent. The burden is disproportionately borne by low-income Americans whose already stretched paychecks are heavily affected by price fluctuations. Again, we kind of can feel that. Just, anybody that's breathing and going to the grocery store knows this stuff, but it's worse than that. It's, I talked about in the last one. Homeowners insurance, auto insurance, it's all going through the roof. Housing and gasoline costs were the biggest drivers of inflation last month, accounting for more than half of the total monthly increase. Rent costs rose 0.5% just for the month, and they're up 5.7% from the same time last year. So just take that in. Just 1 year, rent has gone up almost 6%. And that's only the last year. It's gone up 3 years in a row. Just keep that in mind. Wow. Rising rents are concerning because higher housing costs most directly and acutely affect household budgets. Gasoline prices, meanwhile, jumped 1.7% over the course of March. They are up 1.3% with the same time last year. Food prices. Okay, check this out. Food prices, a visceral reminder of inflation for many Americans, ticked up 0.1% over the month. Again, that's just March. But in total, the cost of groceries is up 1.2% from the same time last year, but they're up a stunning 21% when compared with January of 2021. So in 3 years, 21% food prices. Every time you go to the grocery store. Every time. This was a painful report with few bright spots for consumers. Yep, I bet. So, anyways, the Federal Reserve controls interest rates, borrowing costs. He's coming out today at like 1 o'clock Eastern or 2. I'm not sure exactly. It's like 1 o'clock. And he's going to basically say whether they're raising rates, lowering rates, or keeping them steady. But Fed watchers are going to be watching for what he says to try to predict the next meeting, which I think they're every other month, if I remember right, their meetings. So anyways, that's the skinny on the Federal Reserve, the real down and dirty. They control interest rates, not really the free market so much. Best of luck if you're out shopping for a car or for a home. Like I said in the article, they are still expecting rates to go down by the end of this year, which might be helpful for borrowers. So best of luck. Stay tuned. I'll catch you later. Thanks.